Hey, Warren, my man, Creighton, did you
Joe,
watch
how
that?
are you?
I'm great. Did you see? That was so awesome, that game the other day. I'm not a big Villanova fan, not for nothing, but just because of Xavier, I'm not. I really am not. And they're good players. Absolutely drive me nuts. That DiVincenzo, he sticks a dagger into Xavier so often. But how great that I thought they should have won in regulation, and then you saw how it went. I don't know if you saw the game, but wow, they really came on strong. They got the initial tip in overtime, right, and then they won. And then they beat Villanova. It was awesome.
Joe, we're having our basketball bracket contest for Berkshire employees here in a couple of weeks, and with the same prizes as last year. But if either Creighton or Nebraska ends up winning the tournament, we're going to double the prize. So instead of being $1 million,
this is breaking news. This is what I was looking for. But
this is breaking news.
Yeah, Creighton just barely lost to Xavier, and then they beat Villanova. So I wouldn't. How big is that, Coach? Because he looks big. But then I saw him with his players. He's like 11 feet tall, I think. He's like Hagrid, dude.
He's got a big son, too.
He does, too, who's also awesome. All right, we better get, Becky, we got 3 hours, though, right? We got 3 hours. So
we do. We have plenty of time.
And that was breaking news.
For the next 3 hours.
That was breaking news, doubling.
It was, and I'm sure this was going to come at some point, doubling the prize, the bounty.
If Creighton or Nebraska wins the tournament.
And by the way, is Joe allowed to play this year?
I will include him. I'll book him personally. The company is going to award the prize for whoever goes the furthest. And if you get through the Sweet 16, you get $1 million a year for life, which, if Creighton or Nebraska won, would be $2 million a year for life.
I want a finder's fee, Joe, if you win.
So we can do our own little bet, Warren. Can we do something with, here we go again. I'm like a broken record. Can we do something with NetJets? I mean, can we do something like private jet travel for life?
You win $1 million for life, you can buy your own NetJets.
Is it your brick against my NetJets? Is that what you're suggesting?
That's right. My brick. All right, we got go. I'll start
we'll negotiate.
All right.
All right, let's get right to the news with our newsmaker of the morning. Berkshire Hathaway's chairman and CEO, Warren Buffett, is with us. And Warren, you're here, or we're here, I should say. We're here in Omaha because you just put out your annual letter to shareholders, and you've sat down with us for 7 or 8 years at this point, and let us come out and have viewers read your letter, have questions about that, and then get the chance to talk to you about it. And this is the 53rd letter to shareholders that you've written?
I think it's the 53rd, yeah.
All right, so the 53rd annual letter, and this one was a little different. You actually broke with some of the formatting that you've been doing for years now, where you lay out and go through each of the companies and tell us how they're doing. Why did you decide to shake things up after 53 years?
I'm 87. Maybe I'm in my second childhood, going at it a different way. I just felt we'd sort of worn out that format, and there was quite a bit of information that I would put in the letter that was repeated in the 10K. So we just append the entire 10K, and you're right, it's probably 60 or 65% as long as previous letters.
Yeah, which is, look, as somebody who doesn't like change on any level, I'm amazed to see you doing this. So, yeah, like throwing it right out the window and going with it. But let's talk about some of the big news items that come right at the top of the letter. The first is that there's a $65.3 billion increase in net worth for the company in 2017. $29 billion of that comes from the tax changes from the U.S. government making those tax changes.
Right.
Why don't we dig into that? Explain what that means. How significant is that?
Well, there were two primary items, but they both reduced a deferred tax liability. We had about $100 billion of unrealized gain in equities. Now, when they're sold, you pay tax on that. And previously, when the tax was 35%, we would have had a $35 billion reserve for taxes against that as a liability. That would drop to about $21 billion. So $14 billion, roughly, was a reduction in the amount of tax that when we sell those securities, we will pay. It wasn't cash now, but it reduced the liability. When you reduce the liability, the net worth goes up. And the other important point related to the same thing, deferred income taxes. When we buy some kind of fixed asset, locomotive or whatever it may be, we're entitled in previous years to 50% depreciation in the first year, and let's say it's going to last 10 years to make it last longer, not make it easy. Well, you would normally, on a book basis, depreciate at $1 million a year on a $10 million asset over 10 years. For tax purposes, you got to have what they call bonus depreciation and take 50% of it the first year, $5. So you're going to get the same amount of depreciation over time, but you got the tax deduction earlier, and that became a deferred tax. And we have a lot of that. We've got it in the railroad. We've got it in multiple places. The amount that was saved with the utility companies goes to the customers. Mm-hmm. So that was about $6 billion, and we set that up as a liability because that will go to the customers. But the amount that related to the normal, the locomotives or whatever it may be, we got a reduction because that depreciation will take later on, which for book purposes we've already taken for tax purposes, will come and be taxed at 21% instead of 35%. Those are the two big items.
You were not a proponent of pushing through this tax reform, but you have talked pretty extensively about what it's going to mean for American business. It is a huge tailwind for American business.
It's a huge tailwind, and it's particularly a tailwind if you've got, particularly for companies that have had lots of depreciation and taken bonus depreciation up front. So it's a big item there. Not as many companies have lots of appreciation in marketable securities, but it's a big item for those that do.
What will it mean for American business overall? And as a positive of that, what will it mean for the economy over the next year and over the next several years?
Well, it certainly means corporations will pay quite a bit less in tax than they otherwise would, and because the ongoing rate is 21% instead of 35%. So forget about these changes that apply to the past. When we make money in 2018 domestically and subject to a lot of little things here and there, but basically we'll be paying at 21% instead of 35%. So that's a lot of money, and we haven't really gotten cash yet from this, but we will save cash as we go along.
Joe?
Just thinking about some of your comments in the past, Warren, I don't think you thought American business was overtaxed. You've made that point many, many times. Or maybe you were saying that if they were taxed less, it wouldn't necessarily make it better for them. They're doing just fine the way they were with the old tax rate. You said that many, many times on the show. And I know you think people like you and Bill Gates and others, the wealthy, should pay more. So I think you have a stated sort of objective that the government needs more money to do what it wants to do. In this case, what you just said, is that a positive for the country that Berkshire now is going to have more control about where that capital is allocated rather than the government having control of where that capital is allocated? Is that a net positive for the country or a net negative for the country, in your view?
Well, it depends whether they'd, instead of allocating it to us, they'd allocate it to the people who, on very low incomes. Or if they were going to give a tax cut, the question is who they gave it to. And there are all kinds of provisions in it. But,
no, I just mean, basically, but we're not talking about, we're talking about Berkshire Hathaway now gets that money instead of the government. Do you think that's a net positive that it's kept in the private sector, or a net? Because if you think it's a net negative, you're free to write that check and say, I don't like this tax law, take the money from Berkshire and give it to the low-income people or whatever. You could do that. Or do you think it's better that...
Joe, we have 1 million shareholders. I think I'd get sued by about 999,000 if I start making voluntary payments.
If that wasn't the case, would you do it? Would you give it to, if the shareholders would go along with you? I just think it's really good for Berkshire, and I wonder if you can just agree with me on that.
No, it's really good for Berkshire. There's no question about it.
What about for society? What about for society in general? Don't you think you can do great things with the incremental addition that you wouldn't you rather have it than have the maybe people that don't use it as effectively?
Everybody would rather have it. The question is whether who you give it to.
I've never been able to get you. I can't get you on these things. But I think if I read between the lines, I think you like this. I think it's good, and I think that it's not a net negative for society that the private sector gets to compete globally better. However you want to look at it, it's a net positive. And if you don't like it, I think you ought to just. Because I just sign that check and send it off. It'd be, what'd you say, $29 billion?
Unlike some people, I don't believe in giving away other people's money.
I think that's probably an area where you two could agree.
I think there's times where you've recommended giving away other people's money, although it would include you. Anyway, okay, that's all. That I just wanted to. Now I'm going. I'm going back to the brackets. Let me just see here.
Well, if you win the money, Joe, you're going to pay a big tax on this. I mean, you'll wish they'd cut personal rates a lot more, believe me, unless you incorporate your bracket submission.
We both know about this, don't we, Becky? I mean, between the agent fees and the
state and local taxes, the state and local taxes going up is going to hit a lot of people.
I think my taxes are similar to yours, Buffett. I think I'm paying more than you because you take no income. I do. I think I'm probably paying more than you. I know how you work things.
Yeah, I think you're probably paying a higher rate, Joe. Yeah, I don't think you're paying more in dollars.
But I don't mind. I don't mind. I'm fine. I'm good. I live in the greatest country in the world.
I'm not particular.
I'm not complaining.
I agree with you on that.
Yeah.
No, I do not think we're undertaxed or overtaxed.
Yeah.
Excellent.
Warren, let's talk about another big change that you mentioned in the letter, too. And this is about accounting change that's going to come. And it's going to make your results a little tougher for individuals to really realize what's happening on a actual basis with the companies, how the companies are performing. What is that accounting change? And it's accounting. It sounds boring, but I think it's important.
Well, it is important. Yeah. I mean, we will report, we would have reported, I don't know how much more, maybe 15 billion or something like that more income last year than we did under the rules that have just been adopted, because the accounting profession requires that we now run gains or losses unrealized, just as our stocks go up and down. We run those through the income account. So here we're running a normal business like the railroad, and you're interested in how that does on an operating basis. But we have $170 billion of stocks, and they might go up 10 billion in a quarter and we're down 10 billion. We formerly always reflect that in the balance sheet. Now it has to go through the income account. So you're going to see a bottom line net income figure, which really has no relevance to operating results. And people will look at the report and they look at the bottom and says net income. It'll be a totally deceptive figure. And we're warning people about that.
Right, and you've said that you and Charlie are going to take pains to make sure you explain to people exactly what this means. Have you talked to Ajit and Greg, Ajit Jain and Greg Abel, about making sure if they were in charge of things that they would continue to do the same?
Oh, they would understand that in 1 second. But people are used to seeing an item that says net income and have that mean something. Right. The answer is it doesn't mean anything.
Is that a Berkshire-specific situation, though, because you have 170 billion in stocks?
Yeah, it makes us like securities firms. A Goldman Sachs would have to report that way in the past, but they're in the trading business of stocks and bonds going up. But we've got an unusual amount of marketable securities. But other insurance companies are going to have to do exactly the same thing. So you'll see, you name it, Chubb or whatever it is, that they're going to report unrealized gains or losses as net income or against net income each quarter.
Obviously, that'll fluctuate with the markets going up or the markets going down. Yeah. That'll have a huge impact on things. What you also said in your letter that's so interesting is that you've got $116 billion in cash, at least you did at the end of the year, that you'd love to put to work.
Right.
But when you look around, you have a hard time finding values. You said basically prices for decent but far from spectacular businesses hit an all-time high.
That's true.
Does that mean that the market overall is overvalued based on what you think is fair?
No, not necessarily. I mean, in fact, the stock market relative to the long-term bond market, if people have three choices pretty much if they're going to be in marketable securities. They can own reasonably long-term bonds, they can own equities, or they can keep it in short-term cash equivalents. If you had to choose between buying long-term bonds or equities, I would choose equities in a minute now.
You would choose equities in a minute.
That doesn't mean I think the stock market is going to go up or anything else, but if I were going to own a 30-year government bond or own equities for 30 years, I think equities will considerably outperform that 30-year bond over the 30 years. I don't know what they're going to do in any day or week or month, but I think that I've thought it for a long time, and we can talk more about that later. But
well, overall, is Berkshire a net buyer or a net seller of stocks right now?
And so far this year, we've been a a net buyer, although we sold a chunk of Phillips to get below 10%. So that was a $3.3 billion.
I think it was $3.3 billion.
Yeah. So we bought more than that on.
Really? So even with that purchase,
Right.
that sale, you've still been a net buyer. Is
Correct.
that because of the huge spikes in volatility and the big declines we've seen in the
No,
market?
it's just because we found stocks that we like. If we buy something, we don't have the faintest idea whether it's going to go up next week or next month or the next minute. But if I like it, we buy it. And we've got 170 billion of stocks. I mean, there's plenty of stocks we like. We have not found businesses because you have to pay more than the stocks are selling for if you buy in the public market by some margin. And we just haven't seen anything to buy there.
All right, let's ask a couple of questions from viewers. One is T60. It comes from Chris Rogers. He says, with $116 billion and growing, how confident are you in the future opportunities to deploy such a large amount of capital that would fit the Berkshire mold? And at what point would you consider a dividend?
Well, we would. I'm fairly confident that we'll find ways to deploy money. I mean, we are deploying money right now, but we'll get a chance as we go along, based on history. It's gone a long period now. We've been in a bull market, and the best chance to deploy is when things are going down, obviously. But if we don't, we'd probably be more likely. It would depend on the price of the stock entirely, but the inclination might be more toward repurchase than dividends, because dividends have that implied promise that you keep paying them forever, not decrease them, and so on. Whereas repurchase is assuming the price of the stock is such that continuing stockholders benefit from the repurchase. We would probably lean toward repurchase.
Would you change? I mean, you've been very clear about what price you would buy back shares.
Right.
Would you change the equation?
You might have to change it a little bit. If you had to change it too much, it wouldn't make any sense. So then we'd have to look at
What's the
something
equation right now again? It's
120% a book.
a book value. That's
Yeah.
when you buy back shares
We know that
automatically.
we're doing the continuing shareholders a favor if we buy it at that price. And then that gets increasingly more questionable as you move on from there. And obviously, I leave some margin of safety when I do the 120%. And if we were going to spend a lot of money to buy in stock at some time in the future, and it was 125% or 127% or something like that, we'd probably go that direction.
Rather than a dividend. Although I'll ask this question from Alan Buckley Bucky. It's number 1023 T23. A lot of people came into this very question: why not come up with a one-time dividend? Would you pay a one-time special dividend? And Alan himself asked, you don't like to invest in companies that pay, or you like to invest in companies that pay dividends and buy back their stock, but Berkshire does not do either. Why is that?
Yeah, well, we'd rather have a company whose stock was undervalued spend all their money buying in stock. But the trouble is, if you've established a dividend, you're not going to eliminate the dividend to repurchase shares. So a company that's paying a dividend, take Apple or you name it, I mean, they're not going to cut their dividend to repurchase shares. And they're probably not going to cut their dividend under any circumstances unless their business changed in a dramatic way. So we would do what made the most sense for shareholders. But, you know, I've pointed out years ago, you can sell a little piece of Berkshire every year and still end up owning more of it than you had before. So if you want to create the people who want to turn a little bit of what Berkshire earns each year into the equivalent of a dividend into cash can do it, and they don't force that policy on the other people. And we had a vote prompted by some shareholder I never heard of a few years ago. Some shareholder put on our ballot. He said, "Let's pay a dividend, and let's get this Buffett out of keeping the money from us and pay a dividend." We had the vote, and the shareholders 47-1 among the B shareholders, the smaller shareholders, 47-1. They said, "Don't pay us a dividend." So that was a pretty, and we didn't campaign on it or anything else. The votes just came in
Because they figured you'd do a better job of. Well, by the way, did that include you voting your shares?
I probably voted my shares, but I'm not counting the A shares.
Okay, just the B shares.
But Berkshire, in effect, for 53 years, has been a savings account.
Yeah.
I mean, Charlie put his money in, I put my money in, Berkshire, my partners put their money in, all my partners put it in. And it's a way of saving money over time. And the money gets left in and we invest it, and to the extent that it's worth more than 120 cents on the dollar after we save it. Every dollar we save is worth more than if they'd gotten it out in cash. Forgetting all about tax factors. We would have had the same dividend policy if if the individuals had been tax-free the whole time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.